There's a number that changes everything for cable right now, and it's not the one everyone is watching. Pound dollar is trading at 1.3430, and it looks like it wants to rip higher. Monthly trend strong buy. Weekly trend buy. Intraday is screaming strong buy on the 5-hour and 1-hour. So why did the daily trend just flip to neutral? That single shift is setting the most dangerous trap I've seen since the last BOE decision. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today, and one of them is a counter-trend snipe that could pay out 3-to-1 in a single session. Right now the session bias is a fragile bullish grind, but it is fading straight into a brick wall of resistance. This is not a breakout yet. This is a test, and tests are where accounts get liquidated. The single level that flips the entire structure is 1.3389. Write this number down. If we break 1.3389 on a 4-hour close today, the whole short-term bullish structure resets and we are heading for 1.3328. But if we hold, the melt-up scenario remains completely alive. Here's what the herd doesn't see. The commitment of traders' data shows speculative long positions are at extreme levels while commercial hedges are heavily short. When a chart goes neutral at resistance with a crowd this long, institutions are not thinking about a breakout, they're thinking about where the liquidity is. And the liquidity is sitting right below that 1.3389 pivot. The trap is set. Let's build the map because you need to see the architecture to survive. Start on the weekly chart. Pound sterling to US dollar is a solid buy, holding well above the 200-week moving average near 1.3100, but that's not the active battlefield. Price has been grinding higher from the 1.3350 demand zone after a clean weekly close above the previous range high. The weekly MACD histogram is positive but it's flattening. Momentum is losing its edge. Step down to the daily and the picture gets treacherous. The daily trend is neutral, and the 50-day moving average is sitting right at 1.3450, acting like a magnet and a lid at the same time. The 200-day moving average is at 1.3386. That is the exact line that supports this entire 3-week rally. We are pinned inside a 64 pip cage between 1.3386 and 1.3450. Look at the daily MACD. It just crossed negative with a reading of minus 0.002. That's tiny, but it's negative, and that negative cross has happened while price is still making intraday highs. That's a classic hidden negative divergence. Buyers are running out of fuel. At the same time, the RSI on the daily is dead neutral at 49.8. The stochastic is 53, no extremes. Everything on the daily says indecision, and indecision before FOMC and UK inflation is the breeding ground for a violent expansion. Here's what most traders miss. Move to the 4-hour chart and you see a strong buy trend, with the 20-period and 50-period moving. Averages sloping up, but price is stalling right at the 1.3450 R1 resistance that aligns with the daily 50 MA. The 4-hour MACD is still positive but the histogram bars are shrinking. The ADX is at 23, barely a trending reading. We have a high ATR of 74 pips per day. That tells you the range is wide enough that a break of either side will run fast. Drop to the 60-minute chart. Strong buy bias again, with the MA20 at 1.3426 acting as the pivot of the session, and the 200-period moving average on the 60-minute is at 1.3386, exactly mirroring the daily 200 MA. That is not coincidence. That is a gravitational zone. When a lower timeframe moving average aligns with a higher timeframe one, price tends to visit that level to retest liquidity. The CCI on the hourly is barely positive at 15, and Williams %R is at minus 32, no extreme to fade yet. So the 60-minute is a coiled spring. The path of least resistance appears higher, but only if 1.3450 breaks with authority. If it rejects, the spring snaps the other way, and all those late longs become fuel for a quick 60-pip flush into 1.3386. Now let's connect the fundamental wires, because this is where the dollar killers come alive. Bond spreads and policy divergence. Yesterday, the pound steadied as the dollar shrugged off an oil sell-off ahead of the FOMC. That headline is deeply revealing. The market is completely focused on central bank divergence, and oil is secondary. The Bank of England decision is looming, and UK inflation data is due. Analyst sentiment right now is titled bearish, with reports saying pound sterling to US dollar falls ahead of BOE decision and key UK inflation. But the price is not falling. It's consolidating at 1.3430. Why? Because the market is repricing the Federal Reserve. If the FOMC later this week signals a pause or a dovish tilt, the dollar will weaken instantly, and sterling could explode through 1.3450 in a genuine melt-up. On the other side, if UK CPI prints hot, that forces the BOE to stay hawkish, which is pound positive in its own right. So we have a dual bullish driver stacked on top of a technically neutral chart. This is rare. The 1 to 2 week directional lean is cautiously bullish as long as 1.3386 holds. A daily close below 1.3386 invalidates that lean and opens 1.3328 as the next magnet. The cross-asset link is critical here. Watch UK gilt yields versus US yields. If the 2-year yield spread widens in sterling's favor, the melt-up scenario gains conviction. But if dollar strength returns because FOMC minute surprise, cable will test the liquidity pool below. That brings me to a question for you right now. Do you think pound sterling to US dollar breaks 1.3500 this week? Comment yes or no. I'm tracking consensus. Type it in and let's see the herd sentiment in real time. Most people skip this next section. That's exactly where the money is made. Keep watching, because I'm about to hand you 3 exact trade setups with the levels you need to act strategy. 1 is the sniper, the conservative play for those who want confirmation. We wait for the trap to resolve. The trigger is a 4-hour candle close above 1.3450. That confirms the melt-up is real. But we do not chase. We wait for the breakout retest. Entry goes long at 1.3425 on a pullback after that 4-hour close. This is buying into the pivot zone that turns from resistance into new support. Stop loss sits at 1.3384, just below the 200-day moving average and yesterday's low, because a move back below that invalidates the breakout. Target 1 is 1.3487, the R2 resistance. Target 2 is 1.3511, the R3. That gives a risk of 41 pips, with a reward of 62 pips to target 1, a 1.5 risk reward, and 86 pips to target 2, a 2.1 to 1. Invalidation. A 4-hour close back below 1.3380 voids the entire setup, no IFS, no buts the sniper, conservative, entry. 1.3425, after 4 hours close above 1.3450 and pullback, stop loss. 1.3384 take profit 1. 1.3487 take profit 2. 1.3511 risk, reward. 1 minute and 1.5 seconds to T1. 1 minute and 2.1 second to T2 invalidation. Void if 4H candle closes below 1.3380. Strategy 2 is the active trader, the standard play for those who want to ride the daily trend structure. This is buying the dip into the zone where the herd will be stopped out. Place a limit order at 1.3375, right inside the support cluster between the 1.3389S1 and the 1.3365S2. This is the liquidity sweep zone I showed you. Stop loss goes at 1.3325, below the S3 pivot and below any meaningful structure on the 4-hour. Target 1 is 1.3450, the key resistance. Target 2 is 1.3487. Once target 1 is hit, move your stop to break even and let the rest run. You're risking 50 pips for a return of 75 to target 1. A 1.5R, and 112 pips to target 2, a 2.2R. This setup only voids if we see a daily close below 1.3320. The logic is simple. The 200-day moving average is the line in the sand, and you are positioning with the higher timeframe trend, the active trader, standard, entry. 1.3375, limit order, stop loss. 1.3325 take profit 1. 1.3450 take profit 2. 1.3487 risk, reward. 1 minute and 1.5 seconds to T1. 1 minute and 2.2 seconds to T2 trailing rule. Move stop to break even after T1 hidden validation. Void if daily close below 1.3320 now. Type your pound sterling to US dollar range for tomorrow in the comments. What's your high and low? Let's see who's aligned with the institutional levels I've just mapped. Strategy 3 is the aggressor, and this one is high risk, counter trend. It's only for those who can lose small and manage risk aggressively. We are fading the resistance if momentum fails. Short entry at 1.3440, but only if a 15-minute bearish engulfing or pin bar forms right at the 1.3450 zone, ideally with an RSI divergence on the 15-minute. Stop loss is tight at 1.3465, just above the day's high and the 1.3450 breach point. Target 1 is 1.3389, the S1, and the level I told you to write down. Target 2 is 1.3365, the S2. That's a 25 pip stop for a 51 pip reward to target 1, a 2-to-1 R, and 75 pips to target 2, a 3-to-1 risk reward. The invalidation is simple. If a 15-minute candle closes above 1.3465, you're out, no questions. This play bets that the melt-up trap springs first to the downside, and the long-side liquidity gets grabbed before the real direction emerges. It is aggressive because the overall bias is still bullish, so you must accept that you could be stopped out quickly. Use minimal size, the aggressor, high risk, entry, 1.3440, only on 15M bearish engulfing near 1.3450 with RSI divergence, stop loss, 1.3465 take profit 1, 1.3389 take profit 2, 1.3365 risk, reward, 1 minute and 2 seconds to T1, 1 minute and 3 seconds to T2 invalidation. Void if 15M candle closes above 1.3465. Only for aggressive risk management, never risk more than 1 to 2% per trade. No positions through high-impact news like UK inflation or FOMC. Stops are non-negotiable. This is how you survive to trade the next big move. Here is the single most critical level for the next session, 1.3389. A 4-hour close below that, and the melt-up trap is fully sprung. Bearish acceleration becomes the base case. If we hold above it and push through 1.3450, the breakout is legitimate and we are targeting 1.3511. Tomorrow's wildcard is the UK CPI print combined with the FOMC minutes. That double-barrel volatility event could send this pair on a 150 pip range in minutes. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.